Okay, we are on 8:02. I'm going to go ahead and get started. This session is being recorded, and we may be sending it out to the rest of our client group. And so we won't be having a Q&A for this particular session, but go ahead and email or text me if you'd like to chat after the meeting. I think with most of you, I have already on our schedule. If you want to wait till then, fine. If you want to talk later this afternoon, that's good too. Either way, just let me know. Thanks for joining us this morning. And I think, the reason that we're here on a Saturday morning is because of the announcement that happened on Wednesday in terms of the tariffs that were being implemented. And the way that that came out caused the market some angst, I guess we should say, and thought it'd be a good idea to have this session live and maybe record something for our clients in terms of our thoughts. And maybe just a little head nod before I get going. Can you guys hear me okay? And can you see the screen that says 5 keys to investing? Yes, no, yeah, we're good. Thank you. Appreciate that. Yeah, we are here because of the tariff announcement, at least in particular this morning. And although the tariffs were not unexpected, they had been signaled well in advance that we were going to use this strategy. Um, as the Federal Reserve Chairman said yesterday, and I'll read this, they were significantly higher than expected. And that's really what caused the couple of days of pretty significant market drops. I think 5% a day for 2 days, but about 10%. So S&P is off by about 14% this year, NASDAQ about 17, small caps about 18. But the long-term Treasury bond is up about 6, at least the if in looking at one of the ETFs, and we'll get into all of that here just a little bit later. Um, but yeah, the word significantly higher than expected, I think is people are in agreement with that, and that's what caused that. The markets don't like surprises in general and uncertainty, and so we have both now, and we're going to put that into some perspective as we go forward. So the Fed said that the administration, I think they said it really well. There are 4 areas of focus for the current administration, and they would be regulatory, fiscal, which we'll get into a lot more here, and trade, those two things going together, and then immigration. Uh, Jerome Powell said it's too soon to tell what the real ramifications of this will be. He's being asked about interest rates. Um, and so he says it's too soon to tell, but his statement was that the economy will slow and inflation will rise, and they will be on the lookout to see if these are one-time rises or if it will be an ongoing type of thing that happens. Um, Unfortunately for us as investors in the public markets, we don't have the wait and see luxury. The markets tend to shoot first and ask questions a little bit later, and that's exactly what we saw. I'm going to go back to a little bit of history, 1987, and I was a young investor at the time, and there was a surprise increase in interest rates by the Fed. It was a surprise announcement in October of 1987, and the markets, round numbers, fell about 20% in one day. So we went from about 2,500 on the Dow to about 2,000 on the Dow in one day. And that would have been approximately the equivalent of 9,000 Dow points today. And so that was a result of a very, out of the blue surprise that came from the Fed. Um, and we're in that sort of situation now as well with a surprise announcement on Wednesday and the way that it came out. Market drops do create some opportunities, and so we're not going to talk necessarily about is this a good time to buy or a good time to sell. That is up to every individual client. We can't make a blanket statement for any of you here together, but there are some general opportunities that we will be discussing with our clients. One is these kind of drops like this create some opportunities for what we call tax loss harvesting. We can look at some positions and see if we can capture some losses and then maybe purchase an investment that's a little bit different. So we have some tactical things perhaps we can do with many of our clients in terms of tax. And then additionally, for those that are either doing or considering Roth conversions, there is a theme that says, during market downturns, perhaps that's the time to uh, pay some taxes, move the money from a tax deferred account to a tax-free Roth. And if and when there is a recovery, that recovery for those funds happens in a tax-free manner. So those will be two common themes I would think going forward. They're right out of what I think is a technically sound playbook whenever we get a downturn in markets. So let's talk a little bit about the overview that, how did we get here? Let's get the context. That's really one of the reasons I wanted to have this call is to have a discussion of really the context of everything that's going on, at least through the lens that an investor would be looking through it. And perhaps this is perhaps an aftershock knock-on effect even from COVID. And so when COVID was happening, we became aware of supply chain issues, our dependence on critical materials that we were dependent on other countries to be able to deliver for us, and you couldn't get baby formula in the country at that time, and so it became, although the supply chain had become a global supply chain and everybody seemed to be relatively happy with that. COVID showed us that maybe we need to make some adjustments, and so that thought process took hold. In addition to that, uh, when we start talking about bringing production back to the U.S. for national security reasons and other reasons, also there was a sort of a populist movement that said, "Hey, we would like to have some of these factory jobs back. We got to put people to work in making things here in America again." So those two things sort of got rolling. And in addition to that, in response to that pandemic, the government debt really accelerated. And so, with those three things, looking at getting some jobs back, having to be able to make things here in the US for various reasons, and then a big increase in the debt of the country, um, the next administration comes into office and is going to deal with that. So I'm going to just give an overview of that, and we're going to put some statistics out, some numbers, and I'm going to do my level best to be down the middle politically, and that is virtually an impossible task, I think, in today's day and age. But I'm going to give it my best shot just to put the numbers out there and to have some rhyme or reason for all of us to think, why is the administration doing what they're doing? And it is in no indication um, that I'm in agreement or disagreement with anything they're doing on a personal level. But I think it's helpful for everyone to have some context. So the country has about $36 trillion in debt. Um, we are going to spend in our budget somewhere in the neighborhood of $7 trillion this year is going to go out. And we're going to bring in, we're going to collect revenue of about $5 trillion. And so with that sort of context, then the administration has decided to, they have a strategy to try to deal with all of that. And their strategy is to reduce expenses, try to cut the $7 trillion. I think they've said by 15%, they'd like to get the 7 trillion going out to be 6 trillion. And they like to increase some revenue. And then, so we're here today. Now, the cost cutting has been controlling the news here for the first quarter. And now the revenue side uh, is front and center as to how are we going to go get some more revenue. And there's various ways to do that. Um, we can increase taxes, and it's always an ongoing discussion about whether it's a good idea to increase taxes. Is that good for the economy, bad for the economy? Who do you tax? That type of thing. Um, and this administration has decided they're going to go get a bunch of money from some tariffs. And they put some projections out there about how much that's going to be. There's agreement or disagreement about how much of that will actually show up. But for example, if someone was to go look at a new $100,000 BMW, um, and that car is now 125,000 because there's a $25,000 tariff on it, well, that customer can decide yes or no, am I going to buy that or not? If the answer is no, And some percentage of the people looking at that car, the answer will be no. And so that'll be lower production for BMW, and that'll be harmful for jobs, and it'll pinch their earnings a little bit and so forth. The people who go ahead and buy the car, well, $25,000 will head to the Treasury. And so the government will be collecting more money. And so we're probably going to have a little bit of both. That's why the consensus and hearing from Jerome Powell is there probably be a little bit of an economic slowdown. We don't know how much. And we're going to get some revenue from these tariffs, and we're not exactly sure how much that's going to be either. The alternative would be to, increase taxes, I suppose. Uh, and that's something the administration has chosen not to do. I will say that just trying to understand the facts and how do you go get this much money from the people in the country. And I did a little search on my own because I wanted to know how much money these billionaires have. And they got about 6 trillion bucks. So if we confiscated every nickel from the billionaires in the country, we could drop our deficit from 36 trillion to 30 trillion, but we'd still be spending 2 trillion a year more than what we're bringing in. And so it doesn't appear to be a magic bullet to solve the fiscal issue that we have. And it'll probably, at the end of the day, be some sort of cocktail of all of these things: cutting spending, getting a bunch of money from tariffs. Somebody's going to pay some more taxes. There's already a little discussion on the top rate going back from 37% to 39%. I don't think the administration is too opposed to that, but they don't want to raise taxes on anybody else. Um, so where do you cut if part of the plan is to cut spending, and all parties involved have agreed that nobody should get a Social Security tax cut, and if Social Security and Medicare are off limits, the third or fourth biggest, those are the two biggest expenditures. The third or fourth biggest expenditure is interest on the debt now, and then military spending. And so, if you're going to try to cut 15% of spending and you're going to leave the top three expenditures, or three of the top four anyway, alone, then the other cuts, uh, by necessity, need to be significant. And so this is what you're seeing. That was what was in the news for the first 3 months is significant cuts to the rest of government wherever it can be found. Um, and so we kind of got here. I think if everybody's intellectually honest about this, by uh, our government really kicking the can down the road quite a bit, regardless of which party. It's been a steady march of increased debt along the way, and our generation's responsible. We this happened on our watch. I've got a 27-year-old daughter and a 24-year-old daughter, and I'm starting to not feel real good about what we're about to leave them. And so this administration at this point has decided they're going to not kick that can much. They're going to do something about it, and it is creating a lot of angst. And again, I have no real thoughts on whether this is the right route to go or not. But I do feel like I understand at least uh, the chessboard as it sits, and perhaps what they're trying to do and why. Um, I hope that was okay. I hope politically that didn't offend anybody out there. And it's a very difficult subject to talk about without uh, causing some sort of visceral reaction. I'm going to go ahead from there now that we have a little bit of a context of, why and what we were dealing with. We're going to take a peek. This is a really good informational piece that came out at the beginning of the year, actually, from Capital Group, who used to be American Funds. They're one of the largest investment firms in the country, and they've been a really good resource, I think, for me in the 25 years that I've been in business. From day one, they were outstanding in providing information. And so I have looked to them for education over the years. And I'm going to read this off. So imagine going back in time to New Year's Day of 2020 and learning in advance of the biggest events that were coming in the next 5 years. That before we knew about COVID, that COVID was coming, and that we would have a steep bear market, big stock market losses, short term, although they were. Inflation would get up over 9%, We would have wars in Ukraine and the Middle East. We'd have a trade war ongoing with China and a very rancorous political environment. That was what was coming. And with the knowledge of that, would you have wanted to invest? Would you have been an investor knowing that that stuff and all of these things came unexpectedly? But if even if you knew it, would you have been an investor? And here's a quote here: in my 25 years in the mutual fund business, I've never known a good time to invest. There's always a dozen reasons why it makes sense to wait. We have a new president. We have strife in the Middle East, excessive government regulation, oppressive tax rates, a Congress that is more part of the problem than the solution, says the former Capital Group executive Graham Holloway. Although that may sound like a reflection of the current environment, this is a quote from 1981. The point is, there's always a reason not to invest. And since going back to 20, what has happened since this time? Well, basically, the S&P 500 has doubled. And perhaps it was a little more than doubled, and it may still even be doubled today since the year 2000 before we had heard the word COVID. And so markets have dealt with things. I guess the lesson here is, and we're going to go through some more. Um, we've got what they call Black Monday in 1987. I referenced that when we saw about a 20 some odd percent drop in one day in 1987. You know, the market had been up a little bit and had that big drop and actually finished 1987 slightly positive. Um, and then and you know, we've done quite well since then. The market was 2,500, it went to 2,000, and we're just south of 40,000 today. We had a Kuwait and first Gulf War come around in 1990. There was a recession. We had the collapse of the Soviet Union in 91. We've had currency crisis, peso and ruble, long-term capital management, big hedge fund, roiled the financial markets. Y2K. Y'all remember the angst going up to year 2000? Would the computer systems work on January 1 of 2000? We were all thinking about that. The tech bubble, uh, big technology boom in the late 90s, and that came unraveled in 2000, and there was a big decline in markets that started here in 2000. Um, 9/11 happened to us in 2001. SARS and the second Gulf War in '03. And I will say that there is a missing piece in 2022 that I recall distinctly. And 22 was the third of three straight negative years in the market. And 22 was really exacerbated by, you know, what they call the accounting uh, scandals, where Enron, you remember Enron? So the lesson of Enron and why that was difficult in the markets is that the markets really couldn't tell if the company's earnings were legit or not. And Enron was not alone. There were several. And so that made markets very uncomfortable. If they couldn't tell how much money these companies were making, much less trying to forecast what they would make, then that made markets very uncomfortable. And it sounds similar to today. I think that um, with the tariffs coming in a way that was not anticipated, even if it was anticipated, there was a lot of uncertainty. And so we're in this period of time where analysts are all trying to figure out, well, how much are these companies going to make? How much of their product are they still going to be able to sell? Are consumers willing to pay for it? These are all sort of up in the air unknowns, and markets do not like uncertainty, and hence we saw what we saw over the last few days. After that, avian flu, SARS, you were starting to see viruses, and we had a couple of false starts, swine flu, well, global financial crisis. We all remember what happened in 2008, a very steep decline and a very quick recovery too, or at least a steep recovery got underway. Um, so we survived all of that. Russia, you know, took their first shot at Ukraine back in 2014, the Crimea area. The Brexit vote came around. You know, this was really where the populist movement, I think, started. That was the first Trump administration was coming in. Um, the people over in the UK were frustrated with the rules and regulations that they had to deal with in terms of the EU. And so there was a lot of angst. I know those things sort of diminish over time, but I remember them distinctly. COVID, the entire country shut down. Uh, Another Russian invasion of Ukraine, and what's not listed here is really the inflation genie got out of the bottle. That's how we got to 9% inflation. The Federal Reserve raised the rates from zero-ish to 5-ish percent. The S&P 500 dropped about 18% in 2022. And unfortunately, we didn't get any help from the bond market. We didn't get any help from diversification in 2022. Uh, Lots of bond funds were double-digit losers during this time. And yes, there was a Russian invasion of Ukraine, but the S&P did fall 18% in 2022. And we seem to have forgotten about all that already because 23 and 24 were excellent years in the market. Um, and I suspect that if we look at this chart when Capital Group publishes it again in next year or in the following years or 10 years from now in 2025, you're going to see tariff war, trade war, whatever we choose to call it, will be the next in a very long list of things. And here, in all previous times, we have survived this type of thing and moved forward. And I suspect that we will figure it out. Look, either what the administration is trying to do will work and be effective to some extent, or it won't. And if it doesn't, I suspect the country will change course. Either way, I personally am an optimistic type. I think we'll be just fine, whether it works for us or it doesn't. And we'll find our way forward. That's just my personal opinion. Um, I will say, though, that you're going to hear lots of forecasts for recession coming. All of the investment firms are increasing their likelihood of a recession. And so we'll have lots of discussions about what does that mean? How do investors fare in recessions and so forth? I'm sure you'll see some data coming out on that. But I will say, and it's just important to note that, an analogy I like to use is if the economy is heading for some kind of deep freeze, um, there are some heaters that come on. And interest rates have already fallen significantly. And so that's why, if there's some sort of recession anticipated, then the Fed is going to get a lot of questions about what are you going to do about it? Their typical playbook is to lower rates. Well, they're trying to figure out how much inflation is involved here at the same time, but there's going to be a lot of pressure on the Fed to lower the rates. There are lots of forecasts out there about how many rate cuts are coming, or not. But typically, that is what I would call there's a heater coming on. If the economy is heading into the deep freeze a little bit, there's a heater, and it's in the form of lower interest rates. Additionally, oil prices fell over 7% 2 consecutive days. Both of those numbers were bigger than the stock market decline that we just saw on Thursday and Friday. Oil prices were already down for the year. They're down somewhere in the neighborhood of 30% right now. And so if the cost of moving transportation, moving goods all over the country is coming down, well, that's helpful in terms of inflation. Um, Excuse me, helpful in terms of the inflation problem, perhaps that the Fed is dealing with. Um, and, that is another help, hopefully a way for us to head off some of the economic worries that are coming. I will say with the interest rates doing what they're doing, back here in 2022, when we had a negative market and uh, negative results for bondholders, the diversification did not help. I will say this year, with interest rates falling, and they were falling even previous to these last couple of days, bondholders that were having a pretty good year, even though the stock market was down a bit. Um, the portfolios looked pretty, I would say, reasonably healthy because the diversification was working. International investments had perked up. Um, Bondholders had made pretty good money for the first quarter of the year, and that had offset quite a bit of the negative markets in the United States. And so, um, given the last couple of days, the portfolios aren't quite as healthy looking as they were, but the fact of international outperforming a little bit and bonds making real money has helped quite a bit. So the diversification has been helpful. I'm going to go ahead and bring this to a close. It's been a long filibuster here for you guys to listen in on a Saturday morning. And I look forward to chatting with all of you individually about your personal portfolios and financial plans. And I hope the information is helpful for you with a little bit of perspective. And then we will apply it to your personal situation as it goes. Feel free to email me and text. Um, if you want to chat in the meantime, I'm happy to do it. Look forward to it. This is the time that I look forward to having these conversations with all of you. In large part, that's why you have us here, and it's our pleasure to be of assistance. Okay, doke, guys. Have yourselves a good rest of your week.